We're in the middle of the US reporting season, and during that period stock markets have continued to work their way higher. Indeed, if we look back to the 5th of June, which was the low point of this year, we saw that the market since that time has rallied by 9.5%, and indeed this week it's added another 1%. So certainly the trend for equity markets at the moment remains pretty solid. Those corporate earnings that we have been referring to over the last couple of weeks have come in fairly mixed. It's quite obvious which companies are suffering. We mentioned last week Cummins, which was an industrial group that operates all over the globe, and they were cutting back sales expectations. But the investment banks haven't been doing too badly, and across the board I think it's whilst a mixed picture, I think the expectation going into this reporting season was so low that actually equity markets have managed to work their way higher. What's been happening here this week? Well, the Bank of England took centre stage when they published minutes to their recent meeting. And there was one interesting comment in there worth mentioning, that with regards to interest rates, up until now the view has been that any further reduction in the rate of interest here in the UK wouldn't have the impact. They've changed their tune on that. They are not ready to move on interest rates, but they said that they will review how the funding for lending scheme will take place. This was the initiative that was created with government recently to see whether a reduction in interest rates may indeed have a positive impact. So it was a slight opening of the door there of a further rate cut in the UK, and indeed money markets are starting to price in a quarter point cut by April 2013. That in itself has not impacted on the value of sterling. Indeed, sterling against the euro is moving up through 128. You may recall that bottomed out around 107, 108. So there's been a near 15-20% move appreciation of sterling versus the euro over the course of the last 12 months. So it's certainly making summer holidays a little bit more palatable with those rates there at the moment. And indeed the pound has been moving gently higher against the dollar. So that is in itself interesting. It's interesting for one or two reasons. The UK economy is undoubtedly still under quite a bit of pressure. We saw further downgrades to forecasts from the IMF, who are bringing their forecast down to 0.2% growth this year. And of course, in terms of getting some growth back into the UK when so much of it is in retrenchment areas such as banking, for example, that we've got to turn to exports to try and engineer our way out of this. Domestic demand is slipping. Retail sales this week were reported to be below expectations, and certainly we're seeing now 2 or 3 months of pretty poor retail numbers. So the growth in this economy is going to come through exports, and of course possibly to aid the competitiveness of exports we need the sterling to depreciate. It is appreciating at the moment, and our target market will be the Eurozone. So it's an interesting point that this strength that we're seeing in sterling at the moment may be counterproductive for what we need to see here in the UK. This circular argument obviously comes back to the Bank of England again in terms of what additional things they will need to do. We mentioned also last week about the concept that government may take more direct action into stimulating the economy, and we've seen a couple of announcements actually just within the last week on that. A £9 billion infrastructure programme for the railway market is something that is obviously a big number, but when you look in the detail, some of this has been announced before, and indeed some of this not coming through to 2014. This is not going to be the game changer and the game saver possibly for the Conservative Party. I suspect that they are going to have to take more radical initiatives at this point in their election in terms of trying to sort of engineer some growth so that time they come back to the electorate for the votes that they indeed have a better chance of securing it. I think also we should take note of what's happening in the commodity markets at the moment. Certainly if we look at some of the harder commodities such as oil, Brent crude back up to 107 at the moment. We were quite encouraged that the weakening of the oil price would act as a good stimulant to assist in retail spending. US retail sales, like the UK, are really in a bit of a decline here. We're seeing sort of 2 or 3 months continuously, but oil coming down does help the driver, and particularly as we enter the driving season. So we were encouraged to see that oil price below 100 for Brent crude, but it's back up to 107. Strength coming back into commodities. And I also say that food stocks, we're seeing some really quite adverse weather patterns around the world at the moment, and that is impacting quite hard on things such as wheat, corn and soybeans. commodity markets, which are hitting record highs. We've seen inflation decline here in the UK, and part of the reason for the decline was oil, part of the reason was to do with food. But what I'm pointing out here is that the raw commodity prices are heading back up again at the moment, so maybe we're not going to see the further decline in inflation that possibly we hope to see at this point. Just finally from me, some stock news, just as a small feature, but the retail sector itself has been very much a sharp underperformer over the course of the last year or so, as retail sales have declined, and indeed they've been attractive investments for hedge funds who wanted to short shares in these sectors to obviously value from falling share prices. Well, some of these companies like SuperGroup and Halfords, for example, have indeed delivered poor results, but clearly these poor results were priced into it, and what we've seen is that as the prices started to tick up, we're getting short covering, so we get quite a squeeze in prices. And just to give you an idea, SuperGroup started the week at 320, and it looks like it's closing the week out getting close to 500 pence at the moment. That is a near 50% improvement during the course of 1 week. Halfords likewise lost its CEO. Its trading was truly miserable, but again, no need for further downgrades to estimates, and we saw that price pop up a little bit during the course of this week. And just finally, it's G4S. G4S as an outsourcing group shows the pressure these high profile contracts can bring to a group. It does only impact on 10% of profitability, but with a bid pipeline of £760 million, it would be fair to say that the government will be nervous about awarding further work to G4S in the near term, and so further downgrades are necessary for that stock. So it feels like that company that has grown very aggressively will now spend a period of time in remorse, I suspect, over that Olympic contract.